Alrighty, hey guys, in today's video we're going to be talking about ICT's unicorn setup, how you can execute based on this, and we're going to go through an example. Obviously the markets are still live, but an example that was called out to the Discord live during the PM session. So to see this more clearly, I want to go to the 30-second time frame, and I just want to explain roughly what the unicorn model is, just showing you an example right here. So firstly, the unicorn model relies on three kind of elements to actually enter the trade. The first, right, you need to have, let me just fix this up. The first, you need to have a breaker block, and I might just make that a bit bigger. So you need a breaker block, that's the first thing. The second thing, ideally, is you have a market structure shift, and then the third is you have a fair value gap. So you've got three things that you need, or a checklist that you need to see before you can use the unicorn setup. Now, just because it's a unicorn setup doesn't mean it's going to work. You need to have confluences that go with that unicorn setup, but it is one of the strongest setups you can use based on ICT concepts, and let's kind of talk through it. So the setup occurs up here, but what I want to talk about is what happened during the AM session and also the start of the PM session. So just so you guys can see, this obviously is, the AM session down here. We'll talk about that in another video, but what I want to mark out here is just this period of accumulation, right? There's accumulation pockets as we're stepping the way up. Now, when I came to the PM session, for me, it's in the morning in Australia, I saw that accumulation pocket, and I also saw this accumulation pocket here, and then also I saw this accumulation pocket here. So I like accumulation pockets because they are targets for liquidity, right? And there's a lot of retail traders, support and resistance traders that have their stop losses below these lows, which we can talk about, and you can see how the market's delivered now. So essentially, I use a mix of a few things. I use the breaker block, and I also use the fact that we're sitting in a macro, and I love my macros. So there's a macro from 250 all the way until 310. So I'm going to mark that out just in time so you guys can kind of see. There's the macro between these two grand lines. Now, have a look at this. These two down close candles, right? And I'm going to draw this out for you guys. Let me just make this text a little bit smaller. Now, if you know this already, that's completely fine, but I just want to go through what a breaker block is and how to identify it. So you've got a high there. You've got a low that's formed right here. So you've got a high, you've got a low. You've got a higher high that's formed right here. And then down here, you've got a lower low that breaks structure, right down here. So right here is your lower low. So if I had to mark those points out with like a highlighter, let me mark that out. You've got your high here, right? You've got your low there, you've got your higher high, and you've got your lower low. So that's the structure you're looking for. Now, what you also see is there's a swing low formed here, and there's also a swing low formed here, but this one here gets broken to the downside. So there's your market structure shift, right? So again, for this unicorn model, we need three things: a breaker block, a market structure shift, and a fair value gap. Now, in between this high and this low, these down close candles, or the last down close candle, is the breaker block, right? So because we're on the 30-second time frame, I outline the whole of the two candles like this. I draw that across in time, and then I label that on my chart as a breaker block. Now, I put a negative breaker block or bearish breaker block because we want price to go down. So inside that breaker block, inside that blue section, I'm looking then for a fair value gap. And in this case, I'm looking for a bearish fair value gap. And there's one right here, right? So you can see that there's a bearish fair value gap from the bottom of this candle to the top of this candle. So I'm going to mark that out in red. And this is exactly what I called out in the Discord this morning. Really, really nice trade. SIBI, or bearish fair value gap, and there's a breaker block, right? So again, that's the structure. Now, another thing that's supporting price here, see these two up close candles, they represent an order block, right? So essentially, I'm going to mark that out just in green, just with another box. Notice how in this trade, there are three PD arrays that are supporting price. Three PD arrays, and it's something I like to look for. So in this case, the three PD arrays that we have, let me just fix this up. The first PD array that we have, right, is we have the order block, or the bearish order block. The second PD array that we have is the breaker block, and the third PD array that we have is the CB. So we've got 3 PD arrays that we could be using that should support price, right? So 3 PD arrays, and we've got the fact that there's a clear target or a clear draw on liquidity, right? Now, you don't have to hold to these accumulation lows. You don't have to hold. Like, you can see what price has done now. It's come all the way down. We've taken out this sell side liquidity, right? You don't have to do that. If you want to hold runners or whatever, you can, hold a runner to that sell side liquidity point. But for me, all that was required in this case was take a trade from here, stop loss above the high, and aim for the next sell side liquidity point, which is here. That's the swing low. That's like your low hanging fruit, and that's the sell side liquidity, right? Now let's assume you didn't like this entry. Then you could have got an entry from this CB right here. Now CB just means bearish fair value gap. You could have got an entry from this CB, which is just as good. And if you entered from this CB, say you took a short position from here, you'd put your stop loss above maybe this order block, for example, and target this as your first partial, and then maybe your 1 to 2. My entry, if you got a position from here, I actually pyramided my entries, one there and one here, but let's say you got a position from here and you put your stop loss above that high. This here would be roughly about a 1 to 8.8, 1 to 8.8, so not too bad of a trade. And again, you could hold a runner if that's what you want to do, but this is kind of where the unicorn set up. When you match that across with time, great things happen. So I hope that kind of makes sense. Now we're going to take a deeper dive into this. I'm not done yet. So we're going to take a deeper dive into this trade because there's quite a few more things I want to talk about. Like, these accumulation pockets are really important, and the fact that these entries happened during these time windows is also important. So between 150 and 210, right, and 250 and 310, there's a macro, right? 10 minutes before and 10 minutes after every hour. So this one here is 2:50 a.m. to 3:10 a.m. and that's the macro that we like to see. So I love macros, and notice how the entries come within that macro. The macro gives us an entry, and it also runs to liquidity. So macros are going to seek liquidity a lot of the time, and in this case you can see that. Great example here. We just run off, right? Once the macro is ended, then we start to have a retracement. And the same thing technically over here for this macro, right? If you go 350 to 410, which is roughly about here, you can see we came up, we rated liquidity, and I'll draw this out because when you're looking at a chart, guys, the price or the movement is algorithmic, right? And these are the PD arrays that I have marked on my chart. So have a look at this, that there is a bearish fair value gap. I always mark those out in red. And then right here is an inversion fair value gap. I mark that out usually in like an orange color, just so you guys can see. My breaker blocks, usually they're marked out in blue. Anything else like a volume imbalance is usually like purple. So notice during this macro, and I'll mark that out for you too, which is 350 all the way to 410. Notice we come up, we raid this internal buy side liquidity. Then we move to the downside, right? Price respects the CB and also this CB right here, or bearish fair value gap, and then eventually delivers in this macro to this level of sell side liquidity, right? And then eventually just after we tap into the bottom of this accumulation. So that's like an extension of the analysis into how macros can be used. That there isn't the unicorn setup, but this here is the unicorn setup. Now, just so it's not too complex, let me just go through that again, just quickly, but going over how breaker blocks can be used in the middle of the move as well, right? So this here is on the 1 minute time frame. I'm going to get a new chart up now, and we're going to have a look now at the 2 minute time frame, because on the 2 minute time frame it's quite interesting. Obviously, if I just quickly mark this out, that there's your breaker block, right? We've talked about that, right? And then we've got the bearish fair value gap right here, and that would have been your entry to go short, or you could have entered short from this one here, right? We talked about that. That's a unicorn model that we talked about within the macro. Now, on the 2 minute time frame, I believe it is, and let me just zoom up here, stretch this out a little bit. See these candles here? They are a failed order block. They become a breaker block too, right? So these 3 candles here, they are a breaker block. I'll mark that across in time. I'll make that blue. And this is on the 2 minute time frame. And just look at how price reacts from this breaker. Now, notice if that's your breaker block, there's also a bearish fair value gap that lines up with it, which is a really strong PD array matrix combination, right? So there's your SIBI. So essentially, you could then, if you miss the first opportunity, and let's just go back to the 1 minute time frame too. If you miss the first opportunity, you could take this second opportunity to go short, right? Now the question is, where would you put your stop loss if you're taking this trade? You could enter right as soon as you tap into the breaker here, or you could dig in, maybe at consequent encroachment. You could put your stop above this up close candle, or if you want to be aggressive, just above this candle that forms, this SIBI. You could have done that too. Then you obviously get a 1 to 2 if you hit this low. If you put it above this green candle, you still get your 1 to 2, right? Which is completely permissible. So I just want to illustrate here a little bit of an extra part of this video. The fact that breaker blocks and unicorn setups, they can occur in all time frames, right? Doesn't matter what time frame you're looking at. And again, watching the markets during these key macros is important. So this was like an A+ setup. If you learned something from this, let me know in the comments below. If you got any questions, let me know also. Now, I've started a free Telegram. I've also started a Twitter account, completely free. Obviously, the Discord's there, but I'm going to continue making videos like these for you guys. And tomorrow, I believe, I'm going to be doing a masterclass. So that'll be coming up too. So I'm starting to compile some notes, and we'll kind of go through some things in that masterclass. But until next time, guys, I'll talk to you then.